it's not that simple. So we break it into two parts. So we're going to talk about state as a whole today. We're going to introduce what's called the indirect method, which is the GAP method. And we'll talk about it, and it is supposed to be a little bit confusing. Okay, so if you're confused today, that is okay. Don't expect to like walk out of here understanding it completely. That is okay. Remember, we moved chapter 12 up on purpose. All right, so we'll talk about it a little bit. We'll do a couple problems with it, and then Tuesday we'll do more. All right, but this is definitely, remember what I said about the exam. The first test, the average was 85. That's great. All right, but the second test does tend to get a lot harder because this was all material that you knew. Most of this is going to be new. It just depends on what you've done in accounting prior to this, but this is usually something you haven't addressed before. Okay. All right. So statement of cash flow. So we already been talking about OA, IA, and FA, and the statement of cash flows. So what did we say OA was? You guys got that one right on the test.
Day-to-day activities.
Day-to-day activities. All right, so operating is day-to-day activities. So we're talking about things like paying payroll with cash, all right? Paying suppliers with cash, or people paying us, right, our revenue stream with cash. Those are day-to-day activities. So what would be some day-to-day activities at the college that would come in cash?
The bookstore.
The bookstore, right? So that's auxiliary services, the bookstore, the cafeteria. All right, revenue coming in for that. What else? How about when they pay me? Wages, all right? When they pay me in cash, not wages payable, but when they actually pay me. All right, at the end of the month, they actually pay me. What about your tuition when you pay in cash? All right, that's a revenue stream. Utility bills, when we pay them. Okay, all those things are day-to-day things the college has to do in order to operate. But remember, the key word that I put with every one of those was the word cash. If it's wages payable, it doesn't go on the statement of cash flows. If it's utilities payable, it doesn't go on the statement of cash flows. If you pay your tuition with financial aid, it is not on the cash flows until financial aid is actually paid. And anybody that gets financial aid knows that doesn't come right away. All right, we get that down the road. All right, so those are all those types of things. So what about investing activity?
Buying equipment.
Things like buying equipment, right?
Long assets, long-term assets.
Long-term assets. All right, so property, plant, and equipment. PP&E. All right, well, we go out and we buy things. We buy plant, which is the buildings, property, land, and equipment. So at the college, they are building a new allied health center down at Forest Park, all right, which is nursing. Okay, so they're building that. When they spend cash, it will go under there. Okay, but they have to spend cash. Don't ask me how they're paying for it. Okay, but I'm not sure exactly when they're doing whatever there. They will do that. They already had the land, so there's no land involved.
It's built, like the foundation.
The foundation's in? Okay. So I know they had the groundbreaking last spring, so they're in the process. It's going to take a little bit, but it's going to be nice. Our nursing program is one that is full at all three campuses. So it's one of those things that, but they only can take so many. That's one of the problems. So that's going to help a lot. So when you go out and buy those things, that's where the money is spent. What about when we sell those things? Inflow, right. We sold the Cosan Center, which, if you didn't know, that's the building downtown that we used to own, right across from the Cardinal Center. I heard it, Cardinal Stadium. I heard it just fell through, so right now there's no cash flow coming in, but it will be sold because it's right downtown where they're building all the stuff around All Park Village. So property, plant, and equipment. The other thing that can go in there is investments. All right, investments are when a company actually puts their money into something they think is going to produce long-term money, just like you and I. You and I buy stock, right, for the purpose of hopefully having a return later on. Companies do the same thing. For those that don't know, way back a long time ago, the college bought the land where Marquette High School is. Like, I don't even know how long ago this was, in the 70s sometime. They predicted that they were going to need another campus out west. So they bought the land where Marquette is. And then Rockwood School District came to them and said, we'd like to buy that land. And they decided that their campus probably needed to be even farther out, so they sold that land at a profit to Rockwood, and then they bought the land where Wildwood is actually at now. So it was an investment when they bought it. They bought it early enough that that land was not worth the value that it was at when Rockwood needed to build Marquette. So every company, even nonprofits, buy things for an investment. It's just then how do they spend the money is what it's at. So a lot of times it's investments like land, sometimes it's stock and things like that. What's the last thing? Financial. What goes in there?
Like loans.
Okay, so we got loans. Three things. What else could be some type of financing activity?
Dividends.
Dividends paid,
Stocks.
yep, and stocks. All right, so loans, dividends paid, and stocks. So we could have money coming in the door and money going out the door if we borrow money. If we borrow money, it's coming in. We pay the loan off, it's going out. Stocks usually is only going in because we're selling stock, we get money. But when we pay dividends on those, then the money's going out the door. All right. Now there's 3 exceptions, and they all go under operating. All right. That is, interest is always an operating activity. It's considered a day-to-day activity. It does not go under financing. That's where you guys like to put it, but it does not. Interest paid, interest received, it doesn't matter. It's an operating activity. Dividends received goes under operating. And income taxes. Obviously, income taxes paid because you don't get income taxes received. So income taxes goes under operating. So interest, income taxes, and dividends received go under operating. Just memorize it. Because the one that you guys have trouble with usually is dividends received. You guys like to put it here, and I understand, because if you own stock in another company and you get a dividend, you would think it's an investment, but it's not. It's operating. All right, so interest, income taxes day-to-day, dividends received is day-to-day.
What is dividends received right here?
That means like I get dividends in AT&T. I own stock in AT&T, and they pay me dividends. So the company is getting dividends. And companies own stock in other companies. That's how they, they invest in other companies and hope they do well, just like you and I hope they do well. Okay, why is it not advancing? Oh, it's connecting. The internet is slow. So the next slide's going to come up and just kind of show what we have going on here. I'll do it this way. All right. And then it talks about cash. And the one thing that you want to keep in mind is cash is not just what's in your pocket and what's in the bank, but it's also, remember, cash equivalents. So anything that's 3 months or less is considered a cash equivalent. All right, so this is what a statement of cash flows is going to look like. This is Under Armour. So this is our operating activities. Notice it says cash provided, cash used. So if it's a negative, like investing activities, all that means is we used the cash. So that means we spent $380 million. So here we got $310 million. That means $310 million of cash came in the door. Our revenues exceeded our expenses by $310 million in cash. Investing, we spent $310 million. We used cash of $310 million. What do you think that means? What did we do? We bought $310 million worth of a building, equipment, land, something. Right? And then it says the cash came in the door of $190 million in financing. So what did we do?
Some loans.
We do stock.
We either issued stock or took some loans or did both. Okay? So then it shows your net change in cash, the $120 million. It shows you your beginning cash, $130. So our end of cash is $250 million. So in the bank or on the balance sheet, you would see $250 million in cash. So this ending number right here, this 250, that's what's on the balance sheet. Because remember when we did all 4 statements on the board? The income statement goes to the statement of retained earnings, the statement of ending retained earnings goes on the balance sheet, and then the cash number in the balance sheet should equal the ending cash on the statement of cash flows. So this 250 right here is the balance sheet number. This 130 is actually the beginning balance in cash. This is the ending balance. So here's our operating activities that we talked about. We've already gone through that, so we'll skip over that. Here's our financing. So if you need to come back and take a look, it kind of tells you how they got it. Here they actually used it to purchase equipment and intangibles. And we said intangibles are what?
Like goodwill.
Goodwill. And in this case, it's Under Armour, so they could have bought a logo of some sort if they added a different logo. Yep. And then financing, it looks like they paid off a long-term loan, but they actually took out another one. And that's very common. Businesses will pay off a loan and take out another one. Right. Kind of like when you buy a new car. Right? You pay off the other loan, but then you turn around and take out another one to buy a new car. A lot of people don't go without a loan on a car very long. All right, and then they ended up also issuing stock. Oh, I don't want to do that one. Let's go back. Okay, so now what we have up here, one, I think Lucas already said it, but when we're looking at the statement of cash flows, one of the things that we want to look at is how does it relate to the balance sheet. So when we look at day-to-day activities, how could you relate that to the balance sheet? What on the balance sheet would you consider day-to-day?
Accounts receivable.
Accounts receivable? Huh?
Utilities.
Utilities? Huh? Supplies? And what do we call all those?
Current assets.
Current assets. Okay? And then what else could be considered something that we would spend cash on at a later date?
Accounts payable.
Current liabilities.
Current liabilities. The key there is the word current. Current asset and current liabilities. Current assets, cash, supplies, accounts receivable, inventory, prepaid rent, prepaid insurance. All those things are current assets that we would spend cash on that affect our day-to-day business. Right? Accounts payable, we would spend cash on, and if we were paying an accounts payable, it's going to be something that affects day-to-day business. It could be utilities. It could be them delivering soda if you're a Quick Trip. It could be them delivering the food or the books to the bookstore. Those would all be accounts payable. All right, current assets, current liability. Now, Lucas, you already mentioned what are property, plant, and equipment?
Long-term assets.
Right. Long-term assets or non-current assets. Property, plant, and equipment and investments are all non-current assets. So investing activities is just the one, non-current asset. Any non-current asset is going to be an investing activity if you spend cash on it. And notice I keep saying that because someone's going to miss that on the test. I'm just going to tell you. It's not meant to trick you, but there will be a question, and it's going to have something on there where there's no cash, and someone's going to put it under the statement of cash flows. You have to spend cash on it. All right, so then if we look at financing activity, what are loans?
Non-current liabilities.
Non-current liabilities.
And stockholders.
And stockholders' equity. So in the red, we have the balance sheet. All right? Assets, these two, equal liabilities plus stockholders' equity. So the balance sheet actually fits into the statement of cash flows. So on the balance sheet, if you spend cash, you can figure out where it goes on the statement of cash flows. If you spend cash. And so that's what this next slide is showing you. And this is a good slide just to keep in your head or to print out if you're trying to remember where things go. All right. The red is the current assets, but everything is on there.
Is
Now-
this saying like financing doesn't have non-current liabilities on there? Or is it saying it does?
No, it does. It's
Okay,
purple.
I
So
see.
financing is
It's
purple. And what it's trying to do is show you
Okay.
the balance sheet, the classified balance sheet. So investing is yellow, operating is orange or red, and financing is blue, or purple, I just said. Okay, now in order to look at the statement of cash flows and make sense of it, you actually need to be looking at the other statements. Just looking at the statement of cash flows is only going to show you how much cash they spent, but it's not going to tell you how well the business is doing in other areas. It's not going to tell you revenue. It's not going to tell you how well the balance sheet's going. It's not going to tell you anything about the earnings. So it's just going to tell you if you have cash or not. So Under Armour looks great, don't they? They had $310 million in cash. I would say that's doing great. But what we don't know is, are they actually still selling? We know they're still collecting, but what we don't know is, are they still selling? Because based on that information, we don't know anything. All right, let's look at a couple problems. Let's see if I can switch this around. All right, let's look back at the slides. There we go. All right, so in order to do a statement of cash flows, you need to have the balance sheet, the income statement, and then sometimes you need to have some additional information regarding how they spent the cash and what other non-cash transactions they had. Now, sometimes looking at this throws people off, so if it confuses you, then just ignore this statement. But one of the things that they're trying to do with this slide is just show you how you can take the balance sheet and manipulate it to come up with the change in cash. And I believe I did this with one of your multiple choice questions, and you guys were like, what did you do? I did it on one of the little quizzes. But assets equal liabilities plus stockholders' equity. We can change that real quick and take cash out. So cash plus non-cash assets. All we did is just say, let's make cash assets by itself, and the right side stayed the same. So now we have cash by itself equals liabilities plus stockholders' equities equal non-cash assets. And now we just change it to say change in cash equals change in liabilities plus stockholders' equity minus non-cash assets.
So what would be like a non-cash asset?
What would be a non-cash asset?
Accounts receivable.
Accounts receivable.
Inventory.
All right, inventory. Anything that we do, inventory and accounts payable, that's a non-cash asset. Prepaid rent and accounts payable, which that would be a really weird one, but anything that doesn't involve cash. All right? Yes?
Why did they change it?
Why did we change it to change in cash?
It's supposed to be easier to do.
Yes, because we're wanting to get where we are only looking at the change in cash. We want to get to that number that's made cash increase. We don't care about all cash. We only want to know that singular number. What was the change in cash? Okay. But if you don't like that slide, then don't worry about it. Okay, don't look at it again. Okay. So we are going to talk about two different methods. The method that we just put on the board and the one that I showed you where you just came up with cash went up, cash went down, that is called the direct method. Cash collected from customers went up, cash paid, cash interest, straightforward. It's not as straightforward as it looks. When you look at it like that, you think, well, that's easy. Okay? At the very end of the chapter, I will show you briefly that it's really not that easy. All right? That's called the direct method. All right? The indirect method, you start with net income. And if you looked at all, which most of you probably didn't, but when you did the trial balance, if you looked at all at the statement of cash flows, it started with net income, which is the indirect method. Because investors want to know, okay, on the income statement, how much of that net income did you actually collect in cash? Because think about that. Net income could be $300 million, and none of it could be cash. Because could have all your revenue been on accounts receivable? Yeah. So that means your income statement looks fantastic, your balance sheet looks great, but your statement of cash flows looks horrible. And what happens if all your sales are on accounts receivable?
You don't have any money.
You don't have any money. And if you don't have any cash, you can't go do anything. And then what happens if you don't collect any of your accounts receivable?
You're broke.
You're broke, all right? And that video that we might have time to watch at the end of the semester, all his accounts receivables were fake. So he had millions of dollars in sales. His income statement looked fantastic. His balance sheet looked great. The auditors never looked at the statement of cash flows. He had nothing in his name that he owned. Everything he had was leased. He had no cash. And not one of his accounts receivables was real. Yeah. It's pretty bad auditors. All right. So we are going to be looking at the indirect method because, like always, the direct method is not GAAP. All right. So you cannot do the direct method if you want to stay with GAAP. So we are going to be using this, and the way we look at it is we are going to start, as I throw things around, we are going to start with net income, and as we go through, we're going to end up with our cash balance. And to get to that, we are going to look at the change in our items. We are going to look at the items on the right. We are only going to look at operating activities. All right? When we're talking about this, it is only the operating activities. So if I go back a slide or two, hang on.
When
We're only talking about operating.
When we talk about indirect.
We'll talk about that later.
Okay.
All right? The indirect, the cash flows, the direct versus the indirect method only affects the operating section. The indirect method and the direct method for the indirect, for the financing and financing and investing are exactly the same. So we're going to first look at non-cash assets, and then we're going to look at changes in current assets and current liabilities, and then we're going to look at gains and losses. So we are always going to add in non-cash assets. So what do you think a non-cash asset is?
Depreciation,
Okay, why is depreciation a non-cash asset?
because it's not investment.
It never involves cash. So I'm going to put depreciation, amortization. Okay, they're the same thing. They're the same thing. All right, and what Faja said was they never involve cash. What does she mean? You can't answer because you said it already. What does she mean by it never involves cash?
There's not like a direct cash value to it.
Okay, so like when I do wages expense and wages payable, later there is cash, right? Wages payable turns into cash. And when I do utility expense and utility payable, later it turns into cash. When I do depreciation expense and accumulated depreciation,
No
Send
cash.
cash out.
I'm never doing cash. What does depreciation expense do?
Even out your assets.
Well, it gives us an idea of the use of the equipment, right? The wear and tear. But it doesn't actually physically decrease it, does it? It just tells us we are wearing out that piece of equipment. And at some point, the value of that equipment will go to zero when we write it off. But when we use wages we actually pay, right? And it will decrease cash. So let's look at our income statement real quick. Revenue minus expenses gives us net income. Okay, so we have revenue of $10,000. If we have wages expense and wages payable of $1,000, what would that do to our income statement?
Decrease.
It would decrease it. So our net income will be $9,000. Okay. Did we actually spend cash right now? No. But on our income statement, we would actually have $9,000, but we didn't actually spend cash. What if we had depreciation expense and accumulated depreciation? What would that do? It would also decrease it. Did we spend cash? Will we ever spend cash? But on the wages, would we spend cash sometimes? Could it be wages, expense, and cash? It could. But no matter what happens, depreciation or amortization will never, ever be cash, correct? All right. So remember this phrase. Depreciation or amortization is our only non-cash transaction. All right? Depreciation or amortization is our only non-cash transaction. So if we assume that 100% of this revenue is cash, we got lucky, right? All of our revenue is cash. And this depreciation expense decreased it to $9,000. And we're trying to figure out how much of this net income is cash. Right now, we're telling our investors our net income is $9,000. How much of this net income is cash? Is that right? No. So we have to add back in $1,000 because it should actually be 10. Of our net income, 10,000 was cash. Every single time you see depreciation or amortization, you have to add it back in. It doesn't matter what else is going on. you have to add it back in. That's the easy one. When we look at the other ones, they're not quite as easy. It's something you're going to memorize, all right, but it's not quite as easy. So what they're saying on the next one in the yellow box, changes in non-cash transactions, or non-cash current assets and current liabilities. We're going to look at those. So let's go back to the wages one I just mentioned. Wages expense, wages payable. All right. So we already added in our $1,000 for depreciation. Now we have this journal entry. So now our wages, now we have $2,000. Did we spend cash?
No.
No. But our current liabilities actually did what? It increased. So our current liabilities went up. Right? Our current liabilities went up. But it decreased our net income. Did we want our net income to go down? No. So whenever our current liabilities go up, we're going to add that money back in. Because we want that money to count. So we're going to add $1,000 back in. Because we did not spend cash. Now, what happens if we have supplies payable and cash? Okay, so our current liability went down. Did this cash or this actually go on the income statement anywhere? Did this journal entry affect the income statement?
Why supplies payable?
I just picked a journal entry. I'm just randomly picking journal entries that could affect. Did this journal entry go on the income statement?
No.
No. But did we collect cash?
No.
We gave it away.
We gave it away. We paid it. But it didn't go on the income statement. But we spent cash. We spent cash that last month we didn't spend, right? So we need to do what to the income statement? We need to, let's say it's $500. So when current liabilities go down, we need to subtract the money because otherwise our income statement's too high. We actually paid cash this month that's not showing up on here. It would be exactly the same if this was wages payable. If it makes more sense to you for me to say wages payable, we're paying last month's. We paid $500 of it. It needs to come out. But it's not on the income statement anyway. All right, let's look at a current asset. What about accounts receivable? And revenue. All right, does this go on the income statement?
Yes.
Yes, okay, let's make this 500. Oh, that wasn't on. Okay. Let's make this 12,000. We're just going to make this 10,000 now. Did we actually get cash? No. So this current asset went up when we debited accounts receivable and we credited revenue. Did we get cash? No. So what do we have to do? We have to subtract. So when a current asset goes up, we're going to take that cash out. We did not collect cash. But our net income went up. We need to take that cash out because investors are going to see that we got $12,000, $10,000 in net income, $12,000 in revenue, but we didn't actually collect it yet. When we collect it, cash, accounts receivable, current asset is going down. Is it actually even on here? No. It's on the balance sheet, but it's not on the income statement. So we need to show investors our cash went up, but it's not in the income statement. So we need to go in, and when current assets go down, we're actually going to our assets are staying the same, but our overall, but current assets, that account's going down. So this is a nice grid to look at. All right, if current assets are going up, you subtract it from net income. If current assets are going down, you add it. So assets are the opposite. Liabilities are the same. Assets are the opposite, liabilities are the same. Depreciation and amortization are always added. It's the first thing you do. Go find depreciation. Go find depreciation, see what you can do with it. All right, so let's do a quick